Hey guys, so before we jump into the episode, we just want to quickly mention our live stream that will be showing at 4 o'clock South Africa time on Friday the 26th or 2 p.m. GMT, Friday the 26th. So please be sure to tune in for that.
Yeah, exactly. We're looking at the state of the market over the course of the third quarter. So we're going to be looking at all the main movers in the markets, everything from Trump's tariff to Fed's moves and a whole bunch of other stuff, geopolitical things, and discussing on how it's moved the market, and then having a look forward to Q4 as well, and trying to get some kind of idea of where the market's going to go towards the end of the year. So tune in. It's going to be good. We're going to be publishing a report alongside it, which will also be going out next week. If you want to get access to that, please hit up our website. We're going to have it live on the site on fxscouts.com. And hope you tune in and enjoy it.
So today on Let's Talk Forex, we're going to be speaking about gold. As many of you who watch the Safe Haven Metal know, it's just printed another high. So it's gone over $3,700 per ounce yesterday, in fact. We're recording this on the 17th of September. So by the time you listen to this or watch this, it might be much higher, which is what we're assuming might happen, depending, of course, on what happens with the Fed's announcement later today. But yeah, that's what we're going to be talking about. We're going to be talking about what drives the price of gold, central bank buying, geopolitics, and then, of course, safe haven flows. And we're also going to be talking about why what the Fed is doing later is going to make such a difference to the price of gold. We're also going to be looking at ETF flows, supply, and then what could derail this rally of the gold.
Yeah, exactly. We're going to be looking at these fundamental drivers here, but you're going to be doing a video on the technical analysis of gold price, aren't you, Alison?
Yes. So by the time you see this podcast, which will be Tuesday, the video will be coming out Saturday of that same week. I'll be showing a technical analysis, how you trade gold and what makes the difference between gold and other assets you might trade. Okay, so if we just jump into what's just happened in gold, as I said, it's, as of Tuesday, the 16th of September, spot gold pushed up to a fresh all-time high near $3,700 per ounce. And futures were steady at $3,720 per ounce. And basically, the short-term trigger is a weaker dollar and growing belief, of course, that the Fed's going to cut rates in the next meeting, which is later today. As I said, we're recording on the 17th of September. And most analysts expect a 25 basis points cut with a small chance, although we think maybe a growing chance of a 50 basis point cut. And of course, when you've got lower interest rates, it makes holding gold less costly. So this often pushes the dollar down. And of course, both factors then push the price of gold up.
Yeah, exactly. That's 100% right. And the big picture here is that multiple banks are now seeing higher prices into the year end. Some major banks I saw moved, to 3,800 or even higher. Deutsche Bank today saying that they're expecting prices to top 4,000 by year end. And this is on the base case that the Fed will continue easing, not just this evening, but then maybe a couple more times before year end, plus the geopolitical risks that we're seeing. And we're going to get into these drivers in a little bit. But first, we want to talk about the foundation of gold prices. Well, how did we get to this point? And you can't really start that conversation without talking about central banks. Since 2022, they have been stealth buyers, if you want to call it that, but sizable stealth buyers. In 2024, central banks bought roughly 1,000 tons of gold. That's the third straight year they've bought over 1,000 tons. And this is a modern era record. We haven't seen anything like this. It's fairly unprecedented. And this is obviously a structural change that we're seeing here. This is not just a one-off.
Yeah, and why they're buying gold matters. I mean, basically central banks want to spread their bets beyond US dollars, and they want to protect themselves from sanctions. And they want to also hold something that they can easily sell in a crisis. And of course, if we look at the World Gold Council's 2025 survey, It says that reserve managers still like gold for exactly those reasons. It helps manage risk, and it stops them from relying on a single fiat currency, or single currency, should I say, which is obviously how they manage their risk.
Yeah, absolutely. And it's all part of this this effort we've seen to move away from the US dollar that I think is probably accelerating with the Trump administration. Yeah, and some of the heaviest buying that we've seen in gold has come from emerging market banks. China's PBOC has resumed additions this year after pauses last year. Recent data shows, the continued monthly increases, extending its latest buying run now for 10 months into August of this year. And that's small month to month in ounces, but it's the signal that it's giving here. It's this ongoing accumulation, not just by China, but reserve banks from emerging markets all over the world. And that really matters for sentiment.
Absolutely. And what also happens is that when the central banks buy it up so much, it puts a safety net under prices. So even when, Western investors are unpredictable, that steady official demand means that the declines or the drawdowns are smaller than in past cycles. And another driver is geopolitics, and we call it the haven bid. And in this sort of scenario, risk is the narrative, I guess. So geopolitics is a huge driver, as we know, and we've had many overlapping crises and unclear policy. Ukraine, Russia, tariff uncertainties come to mind too. And this is why at times gold has gone up even as treasury yields rose. And normally they move in opposite directions. And in those movements, the safety hedge instinct often outweighs the usual interest rate logic. So it's a very interesting dynamic that's playing out.
Yeah, no, it's quite unusual. And yeah, in plain English, we just say so when the geopolitical news starts getting ugly and unpredictable, as we've seen over the last year or so, capital seeks insurance, right? They want some kind of respite from high risk assets. And gold is liquid, it's globally recognized, and it's unlinked to any single government's balance sheet, right? It's completely detached from a lot of other assets. Even in Asia, where jewelry demand can soften prices, can soften when prices are spiking, you get investment buying, you get bars, coins, ETFs. This has really been stepping up this year, particularly in China, where households in China are, they're really facing a lot of property market uncertainty at the moment.
And then if we look at India, for example, we saw that, they cut import duties in 2024, which gave demand a bump. But with prices still so high going into the 2025 festive season, people bought less weight, even if they spent the same or more rupees. And that's obviously typical at higher prices, fewer grams, but more rupees that are being spent.
Yeah, so you've got the sustained retail demand as well. We've mentioned the Fed here a couple of times, but let's get into that. Why does the Fed matter so much with gold prices? So gold does not pay a coupon. So real yields, so yields after inflation, are a crucial piece of the puzzle here. So historically, gold and real yields have a strong negative correlation. So when real yields fall, you see gold tend to rise. Prospects for Fed rate cuts lower expected real yields, and they often weaken the dollar as well, pretty much every time. And these are both tailwinds for gold prices.
Yeah, and markets really are leaning into that story at the moment. Futures days have a 96% chance of a rate cut today. And most are looking at 2 rate cuts by the end of the year, especially if the labor market stays soft. And as we've looked at the revisions this year, really soft. And that's obviously reinforcing the bid under gold today.
Yeah, and then there's the politics in the background as well, as there always is, seems to be anyway, since Trump took office. You got loud calls by Trump for deeper cuts, and that's adding a lot of political pressure on the Fed. But really the policy path for the Fed, and I think we'll see that today, is going to hinge on inflation and employment data. But for gold, it's pretty simple. Every basis point off the front end pushes the calculus in gold's favor.
So if we look at investment flows and momentum, particularly on ETFs, after many years of investors pulling money out, gold ETFs are starting to take cash in again this year, especially through Q2 through August. And exchange-traded funds are basically trackers of price. And this matters because ETF buying turns the the macro story directly into ounces. And ETFs are often the extra demand that helps push a price breakout even further, which is what we're seeing.
And futures positioning show that, the money longs have rebuilt here, right? So they're not at the absolute extremes that we've seen in previous price spikes, but that does leave room for trend followers like CTAs to add on the strength if that breakout holds. So there is potential here for a further boost to prices.
Basically, so if we put it together, the official sector demand is the base, ETFs and future flows are, I guess, the accelerator, and the macro are the rates, dollars, and geopolitics, which is, basically the fuel mix. So yeah, we've got a pretty complete picture for further upside moves.
Yeah, no, yeah, absolutely. I mean, it's hard to see a downside to the gold prices at the moment, and that brings me on to supply here, because obviously with gold, it's a fixed commodity, right? I mean, there's only so much of it around, and on the supply side, mine output hit a record high in 2024. And it's expected to increase a little bit further in 2025, with recycling as well coming back into the market due to elevated prices. But these increases are gradual, right? New projects, new mining projects, they take years to come into fruition. So supply has not yet overwhelmed demand. And that's why price can rise even further, even with production at records. We're still seeing a bit of a supply constraint.
I mean, I remember last year when we were talking about the price hitting $2,800 per ounce, and you were like, no ways is it going to get there. I mean, here we are this year, at probably the same time. I think it was about September last year we were saying that, like, it's not going to get, and it got to 2,800 by the end of last year, and now we're seeing it at 3,700.
700, and talking about 4,000. Yeah, I know, it's pretty crazy.
It is crazy. But it also shows you how we kind of just get used to it, hey? I mean, over this year, we've got used to the crises and kind of expecting this to happen with gold. So I guess the translation here is supply growth is steady, not surging, but the heavy lifting is still on the demand side. So what then could derail this rally, if anything? Well, there are three main risks. First, if inflation re-accelerates and the Fed doesn't cut or even hints at hikes, which could cause a geopolitical risk, to be honest. Real yields obviously will rise and this will pressure gold. Then second, a sharp dollar rebound on US growth surprises, looking unlikely at the moment. And then the third, a reversal on ETF flows. And that's if the risk appetite rockets back into equities, which depending on this cut, I guess we'll have to see.
Yeah, I think of those three risks you listed there, I think the third one is the most likely. I don't see the Fed hinting at hikes anytime in the near future. And the sharp dollar rebound, I mean, I think if you're a lone voice in the valley, if you're calling for that. But in the near term, though, I mean, even the gold bulls, even the gold bugs, they do expect a pullback. Look, nothing moves in a straight line. Analysts are looking at probably a 5 or 6% correction over the coming months before we see another leg up. And a lot of this, I mean, we're seeing it today on the charts, aren't we? We're seeing a lot of this as profit taking because prices have surged so much recently. So after this kind of vertical run, don't be surprised to see a bit of a correction. But I don't think we're going to see any kind of sustained move downwards. Yeah, so just the bottom line here, I think, is that the record price you're seeing today is the intersection of a number of events. So we're looking at structural central bank buying, we are seeing geopolitical hedging, and the prospect of US rates pushing real yields down and pulling the dollar down with them.
Yeah, and put the renewed ETF buying together with only a small increase in supply, and your setup is very strong. If the Fed cuts and global conditions stay messy, then many macro investors will probably buy the pullbacks. Yeah, I guess you just got to get ready for volatility.
Yeah, absolutely. I think you're right. I think it's going to be volatile, and I think we'll see a correction, but I don't see any way this bull run's going anytime soon. But yeah, that's it for today. If you found this useful, please share it, like and subscribe, etc. And we will see you next week. And as I said, Alison's got a video on the technical analysis, technical side of gold prices coming out on Saturday. So check that one out too.
Yeah, great. Thanks, Chris.
Thanks, Alison. Speak to you next week.
Cheers.